Hi, I'm Mark King, Investment Editor at Columbia Threadneedle Investments. Joining me today is Mark Burgess, Deputy Global Chief Investment Officer and Chief Investment Officer at EMEA. We're going to discuss some of the key themes driving markets. These include the outlook for the US, corporate earnings and inflation. Mark, let's start with the US, which has recently introduced fiscal stimulus and has this ongoing trade skirmish now with China. What's your take on the region?
We think the region was growing quite nicely, growth of 2.5%, and set fair to continue on that trend. And to that end, introducing fiscal stimulus at this stage of the cycle was probably unnecessary and probably moderately high risk. As we know, unemployment's been falling, consistently, now down towards 4% unemployment, which has historically marked full employment, and so further stimulating the economy as the economy reaches full capacity is probably risky from an inflation perspective. We're not seeing too many signs of inflation picking up, so we're okay at the moment, and clearly it's good news for corporate profits, but at the margin it has the potential to overheat the economy in a way that's not needed. Trade skirmish, again, sort of flies in the face of what one would consider to be in the interest of the global economy, and to that extent unwelcome. Now, thus far, the Chinese response has been pretty moderate, and it probably doesn't have much of an impact on the global economy, but it sets a pretty unwelcome precedent, and were that to escalate, then I think that could be quite bad news for the workings of the global economy, corporate profits, and just general function of financial markets more broadly.
And talking of the global economy, synchronised global growth has been a sort of key backdrop for markets. Is growth still ticking along nicely?
It is still ticking along nicely. Success in life is about expectations management, and expectations had risen quite strongly. So at the margin, probably growth is beginning to disappoint. That's not to say it's not coming through. Growth is coming through quite nicely, but it's slowing down a bit, and expectations had become quite elevated. So whereas a year ago we were surprised by the improvement in the global PMIs and the global economy more broadly, now that's kind of baked into expectations. So at the margin it's disappointing, but that's not to say growth isn't still ticking along. It is still ticking along.
And corporate earnings have been somewhat impressive, and consensus forecasts for the US and Europe do remain quite strong. With that in mind, where are we in terms of equity valuations?
I think equity valuations look okay. We've seen something of a correction, certainly in sterling terms, in equity markets this year. And valuations have come back. I think global PE is on about 13.5 times next year's earnings. And that looks okay, actually. It certainly was higher than that a few months ago. So, that the correction is probably helpful if one's looking to put money into equities. Also, dividend yield looks attractive relative to both corporate bonds and treasuries and core government bonds more broadly. So we think equity valuations are supportive, and given the earnings growth that you just mentioned, I think there's scope for equities to make progress from here.
Now, inflation is a key risk, of course, but it is still low. Are you seeing any signs that it might be creeping up?
There are some very modest signs in terms of wage awards recently announced in certain parts of the world, but to your point, given where unemployment is, inflation is nowhere near where one would have expected it to be. And whether that's demographics, whether that's technology, whether that's deleveraging, given the over-indebtedness the global economy still has, or whether it's all of those things, certainly we're not seeing any broad signs of inflation picking up. The back end of last year, we would have said that was the key risk, because that could have prompted the Fed to tighten aggressively and undermine the sort of financial markets valuation support that we've enjoyed for the last 10 years in terms of low interest rates and quantitative easing. I think we're less concerned about that today, because the inflation signs that we've been looking at are probably more moderate than our worst fears. Now, that's not to say the Fed isn't going to continue to tighten. It will, but I think the expectations now are in line with what the Fed's going to do, and I think that's not going to undermine valuations from an equity perspective.
And finally, Mark, is there anything to suggest the credit cycle is reaching maturity now?
M&A is certainly, going full swing. We discussed this in one of our investment meetings this morning, that, sort of deal logic would say that the M&A cycle is sort of running at about $5.5 billion a year, and that's sort of at its peak from an historical perspective. Year to date, we're still running in line with those sorts of numbers. So companies are buying each other, buying back their own equity, and leveraging up when they're doing that, which is not helpful from a credit perspective. Now, it's not getting out of hand, but it's something to keep an eye on, and would, if it were to increase, be reasons to be more concerned about sort of where credit is and where bonds lie more generally.
Mark, thanks very much.